Awesome. So we're going to talk about student loan repayment. Are all of you 3Ls? What are you? 1L? Good job. Totally beginning with the end in mind. That's fabulous. 3Ls, congratulations. I mean, are you like nervous and excited? Yeah. It's one of those things. I mean, a lot of times, I think most people when they're starting to think about, the student loans, it's starting to get real, right? And it's like, okay. So the first thing is, you gotta remember, pass the bar, focus on that, and then know that there is always a repayment plan. Like there literally is a repayment plan for everyone. So no matter what the situation is, and I'll talk about through some of those options. We'll talk about basically the pathways. They're basically pathways and it's the common approaches that people have in those pathways, but that doesn't mean that that's gonna be how you have to do it, but it's just a kind of idea, food for thought. So the strategies are generally like big law, if you're going private solo. Anybody going big law? Private solo? Public interest? Okay, and then what about JD Advantage? Apparently JD Advantage is the new CEO. Did you know that? Like the old CEO was to be the MBA, and now it's the JD Advantage because it makes sense, right? Everything is so, you have to really know what's going on. But here are the strategies that people usually do depending on the career. And if you can't see that one, we have that one over there as well. I'm not sure which one works better for you. Okay, so you can, big law, primarily, sometimes students will say, you know what, I'm going to make a lot of money for about 5 years, and I'm just going to pay down the debt. That's my strategy, no matter what. Now, when you're in private solo practice, a lot of times you're like, you're not making the big dollars, but you're making a salary, but at the same time, you may also have other objectives and other goals, right? Like buying a house or starting a family, or maybe you need a new car, or any of those type of things. And then when you get into public service loan forgiveness and public interest, the goal really should be pay the least amount for the shortest amount of time. Like that should be the mission, right? You should be going like, okay, how cheap can I get out of this? I mean, that's really it. And then with JD Advantage, it really just depends because, again, at the end of the day, personal finance, a lot more personal than it is financial because we might have some things in common, but it depends on your resources, your backgrounds, the things you have access to, other responsibilities, family, it's all those different things. So let's look at the 4 strategies. Paying debt off quickly, minimizing monthly payments, achieving forgiveness, and then if you need help. Because sometimes that happens. I think one of the things we learned through COVID is that things do happen. So paying off the debt quickly. First thing to do is really first of all, go to studentaid.gov, and what you're going to go and see in there, you're going to see all of your loan details. You'll use, once you log in, there's a little head and shoulders icon. When you click on that, about the 3rd level down, it'll say My Aid. So click on that and review everything. The big thing I want you to check out is look at your servicer, because that is the entity that is going to communicate with you when you exit, right? So there's somebody that's handling that for you on behalf of the Department of Education. So one of the things that you'll do in there is not only look for the servicer, but be sure to make sure that your email and your regular snail mail is up to date, because they will communicate with you using that. So it will be, hey, you graduated, welcome, and if something changes, then they'll use that email. Nobody's going to call you or anything like that. Normally I would say, look at the outstanding interest of the principal, but I'm going to give you guys a gift. Well, I'm not going to. Close your ears. We're only listening. So one of the great things over COVID is this. Generally speaking, when I usually 3Ls on average, the interest that accrues over 3 years on a regular like $50,000 borrowing is about $20,000. And so that's kind of like interest starts from the first time you get in, it starts ticking, ticking, ticking. And so I've been talking to a lot of 3Ls, and what do you think the average interest is that they owe on those accumulated loans? Have you checked in it yourself to see what did you get?
I can't remember what it was, but it was absurdly low.
I know! That's like a bonus, right? So it's like, I think 5 might have been the most I've heard, but usually around 3 or less. And that is because you had 0 interest for a good portion of your time, right? Which is one of the things 3Ls won't necessarily have. You do have it now, you do have a good portion of it, so that's going to have an impact. But that's also why you can't really see anything right now in the loan details, because everything is set to 0, so you can't look at anything. The only thing you can look at is to make sure that the dates are correct and that you did get it, because there is still some student fraud going on where they'll, people have requested maybe money in your name at a different school, so double check it, make sure that those are all your loans, celebrate the low interest, and just think of that as a bonus. So, let's look at the payoff quickly. Here's one of the things. When your servicer communicates you, you're actually at graduation, probably by the time you get ready. What's going to happen is you have 6 months and 1 day to start making your first payment. So graduation date is what, May or June? May. So you have June, July, August, September, October, November. Sometime in the middle of November or December, beginning on your servicer, you'll have to make a payment on your student loans. All servicers, regardless of who it is, will put you in the standard repayment plan. That is the 10-year repayment plan. That is the quickest to pay off, and that's what they do. So if that plan doesn't work for you, then you need to select a different plan. You need to tell them, nope, that is not the plan that's going to work for me. So generally, here's how you calculate if a standard repayment plan would be a good fit for you. So for example, if you borrowed $70,000 and you are starting a job with a salary of $70,000, that's very equal. That generally makes you a good candidate for one of these, like the standard plan or any of the other debt-driven plans. Now, if there's a disconnect between that $70,000 and maybe $160,000, then we're going to look at the income-driven plans. But right now, if you're graduating with relatively a certain amount of debt that's similar to what you're going to earn, you can pick one of these. And these are called debt-driven plans, and they basically work just like a mortgage or a car payment, in that they say, this is how much you owe, and you're going to make that payment over and over again for 7 years, 10 years, in this case, 25 or 30 years, until it's paid. Period. It doesn't matter how much you earn. You don't have to redo anything every year. It's just there. And this is really good because you can pay off more if you want. You can pay it off faster if you want. You can throw as much money on it as you want. And you just need to tell the servicers how to apply it. Because in the past, well, first of all, if the Department of Education regulates how it's applied based on if there's any fees outstanding or any interest outstanding, any money that you give them has to be paid to fees and interest first. After that, then you can target each loan and say, hey, I want to pay off more here, and things like that. But you need to tell them that, because guess what? In the past, they kind of put it how it was best for them. So, go figure, right? That's hard to believe. Anyways, so the other thing that's going on is that whole debt shuffling, consolidation, and refinancing. And so for 3Ls in particular, first of all, if you don't have any older loans, like FFELP loans, you technically do not need to do a consolidation. Consolidation really is only to get you access, potentially, to public service loan forgiveness, if you want. It used to be that they had service providers, different service providers, and you had to consolidate to get one single payment. That's no longer the case. You can have different, and you don't, but that would be one of the reasons to consolidate. And the reason why you want to avoid consolidation is, generally speaking, because they're going to round it up to the nearest 15%. That's, it's like the house in Vegas. Always going to win. And so if you don't need to, then don't do it. Refinancing right now is really only for individuals who might go into those big paying jobs, who have excellent credit, who have a job that's going to pay a lot. Those are really good candidates for refinancing, because the refinancing is generally based on your credit and your job. There are some underlying systematic issues in there that are still a little racist and all that stuff. Like you pay more for, if you ever attended a community college, you pay more if you ever attended a historical black college or Hispanic serving institution, and you're like, how can that be? It's the application process. They ask you not where you went to graduate school, but where you went to undergraduate. And then they make that rate based upon that. And that's like, so you can be a future lawyer, so that needs to change. Do you know what I mean? Like that needs to change. But so refinancing is only truly effective if you know for sure, I will never go into public service. I definitely want to leverage a lower interest rate, even though right now you could wait because the interest rates are so high. and we don't know what happens. I mean, you're definitely going to have 0 interest until the end of June, so nobody can beat that. But it's something that you can evaluate, right? So just thinking about it. So if you are going to make good money, you want to pay it off as fast as possible, that's one way. You can use those programs, or you can minimize the monthly payments based on an income, right? So again, if you have, for example, loans of $140,000 and you're going to earn $70,000, then you have what's called a hardship, and that hardship makes you eligible for these income-driven loans, income-driven repayment plans. And so here, basically, here is what a normal standard payment would look like. So you'd see that. You're going to see that if you log into your servicer right now, you'll probably go, it might be already in there, or it will be definitely by around May. And you're going to go, I'm having heart palpitations, that's definitely too much. And so then you need to figure out, all right, which one am I going to do? Now this extended fix allows you still to do it much like a mortgage in a debt-driven plan, and you're paying a lot less, right? But that still might be too much. And so you might say, you know what, I do need to look at one of these income-driven plans. And so here's one of the things. This is based on like that borrowing $150,000 basically on average. What's very interesting about this, so look at this. The standard repayment plan, you're going to pay back about $191,000. In this one, you're paying back significantly different, right? Because the longer you stretch out the repayment term, the more interest continues to accrue over that time. That's one of the things they're trying to eliminate right now, is potentially get rid of this continuous accrual, which they should. But the way that it stands right now, look at this. So if we borrowed $50,000 each year and had $150,000, these are the pay-as-you-earn, income-based, and the repay. And those are all where they calculate 10%, and they run over 20 years, right? So 20 times you have to re-sign up. Look at this. The total interest paid, $137. Total amount here is very close to this. It's just another way of getting there. So basically, you're still going to pay back that amount, but it's going to be in a different way, in a much more comfortable way, right? It's just a percentage of your income. And so one of the things that they look at is they use that discretionary income calculation. Right now, as it stands, it's 150% above the poverty line, which is nothing for a person of one, like $18,000, $19,000. They're trying to move it up to 225 above the poverty line, which is more aligned with how they do other needs assessments and things like that, and that would get it almost close to $30,000. So if you had a $70,000 salary and they protect about $30,000, that means your payment would come up based on the $40,000. And if it was 10%, it'd be like $375 or something like that. The other thing is, if you're planning on getting married, there's only one repayment plan that you cannot separate out your income. So that goes back to strategy, because you could have temporarily a spouse who is a high income earner, and then you might say, ugh, I want to do public service, I need to make the smallest amount possible. And so then you want to file separately, and then there's only one plan you cannot do. Or you might have a spouse that has limited income right now, and you're like, awesome, we're going to file jointly because that's going to lower my payment. And you can switch repayment plans at least once a year, but actually even more. So if you had a repayment plan and something happened in the middle of the year, like unforeseen, you lost a job, there was major layoff because we had another COVID, then you could contact them and pick another repayment plan based on your new situation, and then your payment could be like $0, okay? So the thing with these income-driven plans, the biggest thing is the annual recertification. You'd be surprised. 50% of people forget to recertify, and if you forget to recertify, they take you from that $400 to that $1,600 until the recertification process is complete. So for you, 3Ls right now, if you are going to make the payment in November, it takes about 2 months to usually get that complete. So by September, after you pass the bar, you are going to go in and then you're going to select the payment plan that's appropriate for you. And next year, you want to do that, give yourself that 2 months as well. So you want to put on your next year's calendar, remember to recertify so that you get your annual recertification. The servicers are supposed to do that, but they don't a lot of times. And that's why so many have been leaving, because they are holding them more accountable. So new servicers are supposed to, but really you have to be your best advocate and your best steward of your own things. Right now, there's still interest accrual and capitalization as it stands, meaning that if you go in and out of one plan. It could accrue interest, and so you have to kind of think about that. But really, here's the thing. If there's an emergency and you need to make a change that's more better for you, it doesn't matter. Yes, it could capitalize, but the thing is to get you stabilized to make sure that you can start focusing on other things, And so, again, those things you could talk through with us. But anyway, so here's how they do that. You also, this gross income, what you can deduct every year is the interest that you paid on your student loans. So you can deduct up to $2,500, depending on how much you earn every year on your student loans from your income, from your gross income. So that's something nice. And then this one you can actually get at AccessLex.org, and you just put in the road to zero. It's a great little PDF. And it shows you the options as it stands right now. Again, Congress is thinking about making some things a little bit different, but as it stands right now, this is how it is. And so anybody can really read this and go, oh, I get it. So here's the plan name, here are the different loan types, so the direct loan or FFELP loan. Here is the date that they had to be eligible. Here's what happens if you have married borrowers, combined income, separate returns, all that stuff. And then if it's 10, 15, or 20, and then that's that. So, again, right here, this revised pay-as-you-earn is the only one that has no cap on your monthly payments, and it doesn't allow you to separate your income. Now, here's the good news. Years to forgiveness, you probably go, why are there two lines, right? So the blue line is years to public service loan forgiveness. If you were in a job and you would be going continuously for 10 years in that job, making payments as agreed upon, after 10 years, you could have that debt forgiven without any tax implications. That's the blue line. The orange line is there because we know, based on tax records and ADP payroll records, that, you know what? Many people are going to work a job and still not have enough money and need to stay in the income-driven repayment plan, even though they're not going to be public service, and that's the only plan that's available to them. But if after 25 years in this plan, or 20 years in this one, and again 25 and 20, if you stay in that plan for that period of time, after that point, your debt will also be forgiven. At this point, it's still taxable. That's one of the things they're trying to change right now with some of the higher education reauthorization. Because the thing is, if you're in that plan because you've been working, maybe you're making payments for 20 or 25 years, getting a tax bill for the remainder that's left over, like this, for example, these are calculated based on that. Like here, if you're in this for 20 years, it's $100,000 that they forgive you, right? And so then you would get a tax liability for that. Right now, for the orange line only. And so they're also talking about eliminating that because really, if you've been in an income-driven plan, most likely you wouldn't be able to take on that tax burden anyways. It would just create another hardship. So they're trying to eliminate that. Now, what's interesting is, it's always like, why do we have so many choices? It's like, gosh, can it just be more simple? This is because Congress is in charge of this. And what happens is they come up with an idea, and then they think they're brilliant, and then they're in this making the sausage, right? So for example, income contingent, and then they're like, oh, we forgot something, or we need to make a change. And then they say, oh, now let's make it it's income-based, and make it new. And then they're like, oops, we forgot something. And now we have the IBR. And then they're like, oh, let's make it, and that's something else, called pay. And then again, they forgot something, and they're like, oops, let's make it repay. So that's why you have all these things over here, which were probably constituents who said, hey, you left me out, you know what I mean? And so that's kind of how that works. But if you had a friend that didn't attend today's session, but knew you attended and said, hey, my goal is to pay the least amount for the shortest amount of time, which one would you recommend to them?
Standard.
Which one?
Standard.
The standard? Well, the standard is you're going to pay, well, technically, in a way, yes.
That's what I'm thinking of.
Yeah, technically, in a way, yes, but out of these ones, the standard one would be the fastest one, but out of these income-driven ones, which one would be the fastest? Or the least amount of money? Yes?
The new IBR, if you qualify.
Yes, the new IBR, because it's only 10%, You know, you could also do the pay as you earn if you didn't qualify for the new IBR, because that's also 10%. And then this one down here is 10%, but what they did here is they took forgiveness would only be in there for undergraduate debt after 20 years, and then you have to pay another 5 years for graduate debt. So in this plan, based on any of the calculations I've done, you always are going to pay more. So if you can be in a plan, if you need to be on income based, you're going to want to be in, like the one you said, the new income based or the pay as you earn, because those are going to be, again, you can see, more beneficial. Look at, that's the repay. You're paying almost $100,000 more in that. And that's built in that timeline to the forgiveness. And yes, there's less forgiveness, but when you think about it, you almost paid $100,000 more. You're not going to pay $100,000 worth of taxes on this $98,000. You're going to pay whatever your percentage is, maybe $10,000 or $12,000. So, you know, in the long run, that's going to benefit you. All right. Right now, there's still what's called negative amortization, which drives everybody nuts. And so one of the things that we want to do is try to eliminate the unnecessary accrual of interest. It is still in the process right now, but we're lobbying heavily on behalf of students to try and get this eliminated, because it's like, well, and also the interest rates. The interest rates are too high, and you know, in that. So right now, though, what happens is if you're in an income-driven plan, and like you saw, that standard was like $1,500, $1,600, the income-driven plan was like $400. In a $1,500 and $1,600 repayment, it's probably about $1,200 of interest, you know what I mean? And you start paying that down. So that $400 wouldn't even pay the interest that accrues. And that's the same thing in this. So if you had a monthly payment of $125, and the interest that accrues was $325, that still would be unpaid interest continuing to accrue. And that has a negative impact in a way on your credit score. Because what happens is, even though you are paying as agreed upon, which is good on your credit score and shows that you're agreed to those terms, in this case, your balance keeps growing, which impacts your utilization formula, which also accounts for 30% of your credit score. And so that's why also they're trying to think about eliminating that, you know, it's just unfair. So they capitalize as often as they can. Pretty much anytime you make any change, regardless of whether you did it, like when you enter repayment. So one of the questions I get always asked, they're like, hey Jackie, can I pay off the interest while I'm in school? You can, and that would avoid capitalization. And again, depending on your strategy, that might be a good move. Maybe you get a bonus with the firm, right? And if you had the goal of paying it off as fast as possible, and you said, you don't have $5,000 sitting there on interest, and I got a bonus of 10, I want to pay down that $5,000 so that it doesn't capitalize. You could do that if you had all your other financial priorities aligned, okay. But generally speaking, if you're going into an income-driven plan, and most of the people are doing that to do public service, it wouldn't benefit you, right? Because you're going to get that money forgiven anyways. And so that bonus might serve you better to start an emergency fund or to help you move and transition and all those type of things. But these are all the reasons why it happens. So let's talk about forgiveness. Again, there's 3 different ways that it can be forgiven. Income-driven discharge is based on the amount of time, those 20 years or the 25 years, that's one. And that is still in place. So no matter if you're not going to do PSLF, you can still have, let's say you work for a small boutique firm, and you're going to make $70,000 or $80,000, and you're going to be still living someplace where, you know what, based on the income, you need an income-driven plan. You just can be in that. What's going to happen is you're going to recertify every year based on your income, and if something changes dramatically, you can switch. But after that 20 years, if you were in that plan, or 25 years, you would be forgiven. Then public service loan forgiveness is if you meet all of the elements of public service loan forgiveness, which is, what happens is, people think like, I'll graduate and then I get a public service employer and that means I'm in the program. And it really isn't like that. Basically what it is you have to meet all of the eligibility requirements, and once you've met all of them, then you apply for public service. Now the other cool thing is that many institutions, like yours, has an LRAP program. And what's so cool about that is that you can use that LRAP program concurrently at the same time and still count towards the income-driven timeline and also the PSLF timeline. So Income-driven and public service loan forgiveness do not have any salary caps, but of course LRAP does, and it also has a time cap. But it could be that, let's say you're working for an organization, and Jennifer just said, what did you increase it to?
What's that?
What did you increase the salary to?
It's at 75,000 AGI, so not even income.
Okay,
AGI,
nice.
adjusted gross income.
Perfect.
Yeah.
So you could have that, maybe you're an income-driven plan for the first 3 years,
Mhm.
and then at the same time you're getting credit for public service loan forgiveness, or for the income-driven, and you're still also getting assistance. Do you want to say a little bit more about that?
And I always try at the end of the year to provide this information again, but we actually have a very broad public LRAP, which in pretty much anything public sector or nonprofit will qualify as long as you are under the salary cap. We even added back in law clerks, people who are working for judges.
Oh, nice.
We do look at those applications a little more closely, but they are eligible. And so for 3 years, if you qualify, it is competitive, but this year, I was telling Jackie, we were pretty much able to give everybody who qualified the amount that they are paying in their loans. So whatever they're paying for that year, you get a forgivable loan, and as long as you stay in the qualifying employment for that year, it's forgiven at the end of the year.
That's awesome.
So, yeah.
I mean, it's a double.
Right. And then the Oregon State Bar has a program too, much narrower range of jobs that qualify, but if you're a public defender or working in legal aid, you can get another 3 years from the Oregon State Bar.
And also, if you are planning to move and not stay in Oregon, in several states, they also have programs because they're trying to recruit lawyers to maybe rural areas and things like that. And so they have, look at those type of things as well, because there is a demand out there, and that can help you. It's somebody else helping you make those payments, and then you can use that money for something else. Again, with public service, you have to actually meet the eligibility requirements, which is having the eligible loans, and they have to be direct loans, having the correct repayment type, all the income-driven repayment types count, and the standard one counts as well. Because even though with the standard you'd have it paid off in 10 years, the reason is if you are in an income-driven plan and you forget to recertify, they put you in the standard repayment plan. And so it takes about 2 months to recertify. So that way at least you would get credit in the event you needed that for PSLF, even though you're going to pay a higher amount. The eligible employment, again, is very specific. It depends on who's sending you the check. And I was just talking about the group earlier about some public defenders are being hired through private firms, and that's being outsourced. And so when they're being hired and outsourced through a private firm, it doesn't count for PSLF. It has to be the entity that pays your check has to be the eligible employment, not the type of work that you do.
Very common in Oregon.
Is it?
There's currently legislative action trying to make it less common, but a large majority of public defense work is handled via contract, and it also doesn't qualify for LRAP.
Yeah,
it's
so
a
that's,
little bit of an
it's
issue.
one of the things, because you have to think about that, and
Right.
it sounds like it would be like, I'm a public defender, how can that not,
Yeah.
you know what I mean? So I wanted to bring that to your attention. And then after you have all those things for 120 payments, then you actually apply for PSLF. You use this form for everything, and that's what makes it so confusing. You use this form to, first of all, get your employer certified. You can also, on studentaid.gov, use the PSLF Help Tool Ninja. And what you do is you type your employer's name in there or their employer identification number, which is what I like to use because that is a lot more clear. Sometimes we use different names and abbreviations and things don't come up. So if you use the employer identification number, the EIN, it'll come up and say, yes, this is a qualifying employer, and then you know. So even when you're applying for jobs, you can already key them in and see, it might be part of your strategy. And so you use that to get your employer certified. You also use the same form to do an annual audit, and then you use this form to apply finally at the end for forgiveness. So that's why it's, you think, that's why it's so confusing, because it's one form for everything. It's just, it's how it is. Now the other thing is getting relief when needed, and that is, again, I love the fact that you had that handout and you're really focused on overall wellness. Things are going to happen. It's how life is. No matter how well you plan or nothing, it's just things will happen. And for student loans, if you are in the federal student loan system, you have options. And so those bump in the roads, it's a couple of different things. These short-term options are deferments and forbearances, but a deferment and a forbearance only lasts for 6 months, and it's also one of those interest capitalizations if they still have it. So my advice would be to, whenever you can, is go for a long-term income-driven plan. Because if things go south, and you need that extra time to get stabilized again, 6 months go by very, very fast. And in an income-driven plan, at least you have 1 year to buy yourself, some time. And again, if something were to happen, it's possible that you could have 0 payment for a whole year, and that could still be compliant for just the long term, the income-driven forgiveness based on length of time. The most important thing is always either contact your servicer and communicate with them, but you also have access to us, because we as a nonprofit, since we partner with you, we have accredited financial counselors like myself, and then you can call us even before you get ready to graduate, and we can talk about maybe which strategy that you decided to use, and if that makes sense, so that you can really have a clear mind about not having to worry about money before you take the bar. Because that's really the one thing. You want to get that out of your mind, because there are options for you. And so if you have that, and then if something happens later on, again, you can still call us. So here's the timeline. You're getting ready, you're near graduation right now, so the goal for you right now is to go on to studentaid.gov, double check to see who your servicer is. If you have not received any communication from them, you might want to whitelist their email address, so when they do send you communication, it doesn't get spammed, because a lot of times those look like spam. And then just make sure that your email address and your snail mail address is up to date. That's what you do right now. Then, 4 to 5 months after graduation, after you've passed the bar, you are going to go, all right, now I need to think about one of those plans. And maybe you'll call me and you're like, okay, wait, I remember something, but I don't remember it all. And then we'll just talk it through and figure out what's your situation right now, and based on that situation right now, what would be the option that would suit you best, to achieve both your financial goals and wellness. And then after 6 months, 6 months and 1 day, you start making a payment after graduation. So that's quite a bit of time you have, a little bit of still not to worry about, right? And then after that, it's about just executing your strategy. And you have to reevaluate things as you change careers. Maybe you get a higher earning job or you get a lower earning job, Maybe you get changes in family, add a spouse, subtract a spouse, any of those type of things. If you get a windfall, a bonus in 3L year, if you guys complete the max 3L year lesson, I'll show it to you, you might get a windfall, right? Which is this max scholarship coming up. I'll tell you all about it. But that $25,000 and $40,000 will go as a 3L directly to paying off your student loan debt. So that'll be a nice chunk. And 3Ls right now have a statistical advantage, even though I'm not supposed to say anything, but you do. You have a statistical advantage, I'll tell you why. All right, so we also have the calculator. And what you can do with the calculator, so you can figure out, all right, here's the field I'm going to go into. You can go to your career services website, figure out the job that your previous peers took, how much that earned, and then you can say also, I know how much I owe, put that into the calculator, and it'll show you what your options are, from the standard one all the way to the other one. And this is how you would get a hold of myself or any of your other colleagues. We have, some of us are doctors, some are JDs, some are MBAs, investment specialists, so we have a wide variety. You can take a screenshot of that if you want, but this is available to you even after you graduate. So, you're going to earn a scholarship entry for this one, and again, we want an Oregon winner, which is why we're here. So you attend this event, I'll tell you what the entry is, so you get that one. If you attend another event, like if you attended the one earlier today, you already have 2. And then if you complete the course in your year, so for 3Ls, it's the 3L course, which is all about life after law school. Figuring out, all right, what's my tax implications? What's retirement? How am I going to start thinking about, insurance, and how do I build my own net worth? And I love what that has in the 3L course. It really is about the net worth and kind of figuring out, what do I need to look at, to track, to know I'm on the right track? If you complete those things, you get extra 10 entries to win. So what's coming up is this right here, April 1st. So 2 1Ls, 2 2Ls, 2 3Ls are going to get that up to $25,000 based on their cost of attendance. And then the grand prize is $40,000 for a 1L, a 2L, and a 3L. And again, you have a statistical advantage. And then 1L, you have coming up, again, May 1st, the additional one, which is the Hannah Artesian Scholarship. And she was one of our board members. And so we're doing that on behalf because it's a memorial fund. And so that's only for 1L. So if you complete your 1L course and you do your 2 workshops, like you know those 2, you get also the bonus points, and they draw from that one. And that one is unique because you can actually split it up over 2 years. So you can split it up for your 2nd year and your 3rd year. And so that money stretches a little bit more. So here's how you get the scholarship entries. So you're just going to go to the first one, which was Ask Edna, log into there, if you didn't do that already, then attend the online event, do all that, and then enter choices, and that's it. So the reason why 3Ls have a statistical advantage is, when we first put together the program, we were on a platform called Max. It was Max Online, right? So when we first started with Oregon, all the 3Ls were on that platform. But then during COVID, we had an opportunity to leverage new technology that was developed during COVID with the learning management platform, and so we switched. And so all the 1Ls are on there because they don't know any different, but some of the 3Ls haven't migrated back as fast as everybody else. And that is what the scholarship drawing is from the course out of the Ask Edna module. And there is significantly less 3Ls migrated back. So your chances are very, very good. And again, you can take a screenshot of that if you want to. And then really, it's about, I would say, as you're preparing for graduation, it's eliminating the financial stress, figuring out what your best practice is, you know, what you want to do, and then talk it through. Call me. And for you, know exactly with your 1L year, what's great is you're beginning with the end in mind. And so you're realizing, okay, you know what I mean? You have an opportunity every year to make choices to kind of help reduce that. So, how about some questions? I'll help you make sure you get this code entered because I do want that to happen. So let me know if you need any help with that. Do you have an idea of which plan or which approach you might want to use? Kind of as you're thinking about it. No, because it does take some, you have to think about, okay, because people, usually if you're thinking about in the next 3 to 5 years, what your life will look like, right? It's going to be not only professionally, but it's personally, it's going to be financially, so there's a lot of things that are going to happen in the next 3 to 5 years, you know what I mean? And if that kind of decision making was easy, everybody would be doing it, you know what I mean? Like there'd be no problem, so there's a lot to think about. And I guess really in that case I would just say, again, you know what, do the best you can with the information that you have at the time. If it wasn't the best, learn from that. Try to recoup as fast as you can. Reach out, do the free one-on-one coaching, and be kind to yourself. We haven't been doing money very well as a society since, actually really right after World War II when they started doing, actually the Great Recession, Social Security, credit cards and stuff are relatively new since the 70s. I mean, we're just still getting the hang of it. So don't be so hard on yourself. And the number one thing you can do is just get help from an expert. And then that's like, you know this better than anybody else. People are going to see you because they're going to go, what are my options, right? You know it, I don't know it. And so that's the same thing. You have an opportunity to do that for free. So, all right, well, that is it then. I thank you. Log into the Ask Edna at accesslex.org, and then you can go into Max by AccessLex. At the very top, it'll say Get Started. If you click on that, there'll be the Max 3L course. That course will take you about an hour and a half to complete. Do the pre-assessment and the post-assessment. I still do an evaluation on that. That might take you a minute, so that takes the least amount of time. But it has to be complete then, and then you get the extra bonus points. And each section might take about 15 minutes, and I can personally tell you there is nothing to binge on Netflix, Prime, or any of those things. So take the weekend, binge that, bag those points, and if we get a winner, then we get a winner. You know what I mean? So, and you'll think about things you're going to be thinking about anyways. That's really the one thing that happens most of the time.
New season of Carnival Row, so.
Carnival Row! Oh. All right, well, you got an hour and a half before that. I was like, All right, I haven't even seen that one yet. How many seasons are there of that?
This is just the second. just
Oh,
for-
okay. Right. Okay. Dang it. Shh. No. All right. Any other questions I can help you with? Then I thank you for attending today. I appreciate it. Tell your friends that they have resources available. It is free to them. There should be no financial stress before taking the bar. You know what I mean? You can talk this through and you know what your options are. Focus on passing the bar. That's your number one goal.
Thank you.
You're very welcome.